The housing market today is like a Rubik's Cube, filled with colors, complexities, and contradictions. We're living in a time where the housing market indicators are a bit like reading tea leaves, confusing and contradictory. You've got some analysts predicting a housing market crash, while others are betting on a rebound. Now, let's delve into the nitty-gritty. We have regional disparities in the housing market painting a rather vivid picture. Picture this: home prices on the West Coast are taking a nosedive, while those on the East Coast are skyrocketing. It's like a seesaw that's lost all balance. But that's not all. Home prices have been in a slump for 7 consecutive months. That's right, 7 months of downturn. Yet, in a twist of events, we see pending home sales on the rise for 3 consecutive months. Now, if that's not a paradox, I don't know what is. And let's not forget about the mood of the American people. There's a certain gloominess when it comes to the outlook on home prices. Americans are expecting only a 2.6% increase this year. To add to this, they're also bracing for mortgage rates to surge beyond 8%. So the housing market right now is a mixed bag, but the question is, will it crash or rebound? Only time will tell. Now, let's shift our focus from the housing market to the Federal Reserve and its monetary policy. The Federal Reserve, or the Fed as we often call it, has a pivotal role in managing the economy. And today, we'll explore a perspective from Liz Ann Saunders, chief strategist at Charles Schwab. Saunders posits that there might be a bit too much optimism in the air regarding the Fed's ability to quickly pivot its monetary policy. Specifically, she refers to the transition from pausing its monetary tightening campaign to slashing interest rates in 2023. But hold on, this isn't as simple as flipping a switch. There are underlying conditions that need to be met. A significant weakening in the economy or labor market is one such condition. Only when these sectors show signs of distress would the Fed consider a drastic shift in policy. But here's the thing, the current economic data doesn't point towards any significant weakening. In fact, we're seeing strong job growth and expansion in the services sector. Now that's positive news, but what does this mean for the Fed and its monetary policy? Well, it suggests that the Fed may not need to take drastic measures to avoid a recession. This is a nuanced situation, and it's crucial to understand that the economy doesn't always follow a predictable cycle. In the words of Saunders, the economic situation today is not following a typical cycle, but rather a prolonged and rolling nature. So while we anticipate future moves from the Fed, let's remember that these decisions are contingent on a multitude of factors, and not all of them may be visible or predictable, and that's the fascinating complexity of monetary policy for you. From the Federal Reserve, let's move on to the US dollar and how it impacts equity indices. The dollar has been ticking up, a trend seen most clearly as traders wait for US payrolls. This anticipation is driving the dollar's rise, and it's a development that could significantly impact upcoming central bank meetings. Speculators have been cautious, hedging their bets due to the potential for interest rates to rise. Now let's delve deeper into how economic surprises can impact different equity indices. Economic surprises such as unexpected employment numbers or inflation rates can cause significant ripples in the equity indices. For instance, employment surprise numbers have shown to have a substantial effect on the S&P 500 and Dow Jones Industrial Average indices. However, the Nasdaq seems to be more resistant to these fluctuations. On the other hand, inflation surprises can send shockwaves through all 3 indices. For example, when the US core CPI data was released in April 2021, the Nasdaq index experienced an immediate drop. This shows the sensitivity of the market to unexpected inflation data. There is also a distinct difference in how different equity indices respond to these economic surprises. The Nasdaq, for example, is heavily influenced by inflation numbers, while the Dow Jones Industrial Average reacts more to employment numbers and other indicators. The S&P 500, however, seems to feel the impact of payroll numbers the most, though inflation remains a significant factor. As we can see, the dance between the dollar, equity indices, and economic surprises is a fascinating one. And it's a dance that investors need to keep a keen eye on. In this whirlwind of economic events and indicators, it's easy to feel overwhelmed. We've journeyed through the paradoxical housing market, where West Coast prices plunge while the East Coast surges. We've deliberated on the Federal Reserve's monetary policy, considering the potential for interest rate cuts in the face of strong economic data. We've also examined the influence of the US dollar and economic surprises on equity indices, highlighting the distinct market movements in response to these factors. Remember, knowledge is power. So stay informed, stay tuned, and don't forget to hit that subscribe button for more insightful economic updates.